Billionaires are pulling ahead of the global economy at a speed most of us can't even see. And number one is something almost nobody guesses. Stay tuned until the end to uncover the hidden catalyst. Imagine a billionaire who owns a tiny slice of a startup that later becomes a multi-billion-dollar titan. That slice can explode in value far beyond traditional market returns, often delivering double-digit annual growth that dwarfs the 3–4% global GDP rise. Venture capital stakes are especially potent because they tap into disruptive technologies before they hit mainstream markets, allowing early investors to ride exponential curves. According to reports, a modest $10 million venture fund held by a billionaire family can multiply its worth by 10 times within a decade, outpacing the world economy's aggregate growth multiple times over. Moreover, these investments are frequently held in private vehicles, shielding them from public market volatility while still benefiting from the rapid scaling of tech giants. The secrecy surrounding these private deals also means the public often underestimates their impact, making the wealth gap appear less dramatic than it truly is.
Surprisingly, many of the world's richest individuals channel a large portion of their earnings through private foundations that serve both philanthropic and fiscal purposes. By donating appreciated assets, they can deduct the fair market value, effectively reducing taxable income while the foundation's investments continue to grow tax-free. Researchers estimate that this strategy can shave off up to 30% of potential tax liabilities, allowing the underlying wealth to compound at a rate far exceeding ordinary after-tax returns. The foundations also enjoy lower capital gains taxes on any future sales of holdings, further accelerating growth. While the charitable intent is genuine for many, the financial mechanics create a powerful engine that propels billionaire fortunes ahead of the global economy's average pace. Over time, these tax-advantaged structures become self-reinforcing, turning philanthropy into a strategic asset class for the ultra-rich.
Consider the private equity arena, where billionaire families allocate billions into buyouts and growth capital that are rarely accessible to the public. These funds target companies with undervalued assets, restructure operations, and exit with substantial premiums, often delivering internal rates of return in the high teens or even 20s. According to industry analyses, such returns can double the wealth accumulation speed compared to the roughly 3% annual global GDP increase. Moreover, the illiquid nature of these investments means gains are realized over longer horizons, allowing compounding to work uninterrupted by market cycles. Because private equity firms charge performance fees, the incentive to maximize exits aligns with the investor's desire for outsized growth. This synergy creates a feedback loop where successful exits fund new acquisitions, perpetuating a cycle of accelerated wealth that outpaces broader economic trends.
Hidden within the glitter of skyscrapers lies a real estate playbook that billionaire investors have refined for decades. By targeting high-growth emerging markets, they acquire land and develop premium properties before local demand surges. Data from real estate analysts suggests that capital appreciation in such regions can outstrip global GDP growth by a factor of 2 to 3, especially when infrastructure projects and urbanization rates are booming. Additionally, rental yields in these markets often hover around 8–10%, far above the 2–3% yields typical in mature economies. Because these assets are held long-term, the compounded returns generate a wealth-building engine that consistently outruns the world's average economic expansion. The combination of rapid price escalation and robust cash flow creates a dual-benefit scenario that many high-net-worth individuals exploit to stay ahead of macroeconomic trends.
Rarely do people associate a painting with financial outperformance. Yet the high-end art market has proven to be a surprisingly resilient wealth multiplier. Auction records indicate that blue-chip artworks have delivered annual returns of roughly 8–12% over the past 2 decades, comfortably beating the global economy's growth rate. Moreover, these assets are largely insulated from traditional market volatility, offering a hedge against economic downturns. Wealthy collectors often acquire pieces at early stages of an artist's career, then watch values skyrocket as reputations solidify. Because art can be loaned to museums for fees or displayed in exclusive venues, it can also generate ancillary income streams. While the market is niche and valuations can be subjective, the documented appreciation patterns suggest that strategic art investments act as a quiet accelerator for billionaire portfolios.
Shockingly, the volatile world of cryptocurrency has become a cornerstone for many ultra-rich investors seeking growth far beyond conventional assets. Since its emergence, Bitcoin alone has posted an average annualized return exceeding 150% in its early years, dwarfing the 3–4% global GDP increase. While the market experiences sharp corrections, billionaire investors often allocate only a modest portion of their net worth, allowing them to capture upside without jeopardizing overall stability. Institutional-grade custodial services now enable these individuals to hold digital assets securely, turning speculative tokens into long-term stores of value. Additionally, decentralized finance platforms offer yield-generating opportunities that can produce double-digit percentages, further compounding wealth. Though the space remains speculative, the documented performance of leading cryptocurrencies illustrates a powerful engine that can propel fortunes ahead of the broader economy.
Few realize that the simple act of parking cash in offshore accounts can dramatically boost wealth growth. Certain jurisdictions offer interest rates that are several points higher than those available in domestic banks, especially for large, negotiated deposits. According to financial analysts, these premium rates can add an extra 1–2% annually to a billionaire's cash holdings, which, when compounded over decades, creates a sizable divergence from the global economy's average growth. Moreover, the confidentiality and favorable regulatory environments reduce exposure to tax erosion and currency devaluation, preserving capital in its most efficient form. While offshore banking has faced scrutiny, the financial advantage it provides remains a discrete, yet potent factor in accelerating ultra-wealth accumulation.
Beneath the surface of charitable giving lies a sophisticated investment strategy: philanthropic venture funds. These entities blend mission-driven capital with profit-seeking objectives, allowing donors to fund innovative startups while retaining equity stakes. Studies show that such hybrid funds can achieve returns comparable to traditional venture capital, often in the high teens, while simultaneously advancing social causes. For billionaire donors, this creates a dual benefit loop: impactful projects receive financing, and the underlying equity appreciates at a rate that outpaces global GDP growth. Because the funds are structured as private entities, gains are realized within the donor's broader portfolio, further compounding wealth. This synergy between altruism and profit generation explains why many of the world's richest are turning philanthropy into a high-performance investment vehicle.
Meanwhile, the rise of family offices has given billionaires a centralized hub to orchestrate diversified investment strategies across asset classes that most investors never access. By allocating capital to alternative sectors such as hedge funds, commodities, and private debt, these offices can capture returns that consistently beat the modest 3–4% global economic growth rate. According to industry surveys, well-structured family offices achieve average annual returns in the mid-teens, thanks to their ability to move quickly, leverage deep networks, and employ bespoke risk management frameworks. The consolidation of expertise, technology, and capital under one roof also enables seamless reinvestment of gains, creating a compounding effect that propels wealth forward at a speed unattainable through conventional portfolios.
Ultimately, the use of legacy trusts serves as a timeless engine for wealth to compound across generations, keeping growth insulated from external economic pressures. By placing assets into irrevocable trusts, billionaire families can lock in favorable tax treatments and protect capital from probate costs. Financial planners estimate that such structures can preserve an additional 5–7% of wealth annually, simply by avoiding taxes and fees that would otherwise erode the principal. Over multiple decades, this preservation translates into a compounding advantage that significantly outpaces the world's average economic expansion. Moreover, trusts often incorporate provisions for reinvestment, allowing returns to be automatically funneled back into growth-oriented assets. The result is a self-reinforcing mechanism that sustains and accelerates billionaire fortunes far beyond the pace of the global economy.
We've just unraveled 10 surprising ways billionaire fortunes accelerate beyond the world's economic growth, from venture capital rockets to quiet tax-saving foundations. If you found these insights eye-opening, hit the like button and subscribe so you don't miss the next mind-blowing list. New episodes drop every week. Which method blew your mind the most? Share your thoughts below, and let's keep the conversation going. Thanks for watching, and see you in the next video.